Hi students, I am Prakash, Chartered Accountant and acting as academic advisor in Masterminds from the past 20 years. Here is a short video introducing matchless Masterminds briefly for the convenience of the students who came to this channel for the first time. Masterminds was established in the year 2002 and has been acting as a reliable platform to offer coaching for CA and CMA courses. Masterminds is undeniably the pioneer and the leader in MEC, CEC, CA and CMA courses with nearly 20,000 admissions per annum. This is an incredible initiative by three edupreneurs, namely Mohan, Radha and Prakash, that is me. All three qualified CA at a very young age of 21 years and started this organization under the mentorship of my father, Mr. M. Siv Prasad Garu. So Mr. Mohan is my brother and Radha is my sister-in-law. And by the way, it's me, Prakash, Chartered Accountant. So here are the courses for which we offer the coaching. We offer coaching for MEC, CEC groups exclusively at intermediate level. And we also offer integrated coaching for MEC along with CA, CMA Foundation. And we also take exclusive admissions for CA, CMA Foundation or CA, CMA Inter. And we also offer coaching for CA, CMA final level as well. Recently, we have started a unique academic program at intermediate level, that is MEC Pro, aiming for the students who want to pursue BBA or MBA or CLAT courses in future rather than CA or CMA, and we have received a huge applause for the same. So 20 years of experience, and we have finished more than 155 batches of CA or CMA Inter in Guntur alone and similar number of batches in all our branches together. So till now completed 17 batches of CMA Inter and 18th batch is going on. Successfully completed 25 batches of CA final till now and 26th batch is running now, and we have also successfully completed 4 CA or CMA final batches in Hyderabad. So till now our students are able to achieve 990 All India ranks at various levels of CA, CMA courses, and our students are able to achieve first rank for 48 times in various courses for which we offer coaching. So in a single year, our students are able to achieve 3 All India first ranks in the year 2020, and till now our students are able to achieve state first rank at MEC intermediate level for 18 times, that too 8 times in a row. In a single attempt, our students are able to grab 98 All India ranks at CMA Inter and final results of January 2021 and our All India ranks in February 2022 CA results. And here are the 10 All India ranks in CA final results of 2021 alone. And till now, our students are able to secure 93 All India ranks at IPCCR CA Inter level in the last 9 years. And here is our physical presence: Guntur, Vijayawada, Hyderabad, Amirpet, Dilshuk Nagar, Vizag, Tirupati, Kurnool and Rajahmundry. And here are the locations where we have branches. And here are the contact numbers. Here is the list of our physical presence and here is the list of our online presence. And for your kind information, we don't have branches in any other locations other than stated here. So please do install our Android app Masterminds Online Classes from Google Play Store, and if you belong to iOS platform, then install an app called Class Plus from Apple Store and enter the organization code as MZGUN. In this app, you can find a large number of useful content like regular batch videos, crash batch videos, rapid revision batches, guidance classes, motivational videos, amendment videos, Masterminds test series, whatnot. Large amount of useful content is already available in the app. In our app, you can find a section called study material where large amount of free content is also available. Until now, more than 24,000 students have already downloaded our app and we are nearing to 25,000. Sir, is it possible to interact with the directors directly? Yes. If it is an administrative issue, you need to contact Mr. Mohan sir on this mail ID. If it is academic issue, you need to contact me on this mail ID. So thanks to all our students who are our true brand ambassadors and who helped us to reach this position. All the best.
So hope you are well and healthy. So one of the important point is now we will going to discuss the RTP applicable to May 2022 examination for CA Inter. Around 15 questions are there in this RTP. All are very important in examination point of view. So I'll give you one important suggestion. Don't skip this RTP applicable to May 2022 examination, because each and every question involved in this RTP is very important question in examination point of view. So unique provisions, and some of the questions are amendments related problems. So don't forget and don't skip this RTP for preparation for 2022 May examination. Okay, so I give you the clear explanation for each and every problem involved in this RTP. So first of all, question number 9. Question number 9. So question number 9 is related to residential status. Residential status. Residential status. Answer this question. Compute the total income is exclusively related. It involves section 5 and section 9 also. Residential status 1, and 1 point is related to residential status 2. So from the following particulars of income furnished by Mr. Ashutosh, age 65 years. Important, age 65 years. Pertaining to the year ended 31st March 2022, compute the total income. Compute the total income for the assessment year 22-23 if he is resident and ordinarily resident. Resident and ordinarily resident. Second one, non-resident. So therefore the conclusion is, answer this question. Compute the total income of the assessee. So if he is ROR, if he is NR, is nothing but answer this question in two different statuses. One is resident and ordinarily resident. Second one is non-resident. Okay. So point number 1. So answer this question in two statuses. First status, resident and ordinarily resident. Second status, non-resident. Point number 1. Capital gain on sale of land in Jaipur. One of the important point. Section 5 says that where the place of earnings, place of accrual of income, or place of receipt of income, if anyone located in India, then it will be taxable in the hands of all assessees irrespective of the residential status. So here the land was located in Jaipur, therefore place of accrual located in India. If place of accrual located in India, then place of receipt is relevant. Place of receipt, don't consider the place of receipt. It will be taxable in all cases irrespective of his residential status, even if such amount was received outside India. So therefore this amount 1,50,000 will be taxable in two cases. Taxable, point number 1, taxable in two cases, 1,50,000, 1,50,000. Reason is place of accrual located in India, because the land was located in India. Whenever the source of income was located in India, then automatically place of accrual located in India. Then it will be taxable in the hands of all assessees irrespective of the residential status. Taxable even if he is a non-resident also. So here the capital gain on sale of land in Jaipur, the land was located in India, therefore the place of accrual located in India, it will be taxable in both the cases. Okay. Next, second one, rent from property in Delhi. Bus, the property located in Delhi. Property located in Delhi, the place of accrual located in India. Therefore, don't consider the remaining data. Blindly, it will be taxable in two cases. But here, one of the important point, rent is not taxable as it is under the head income from house property. Out of rent, standard deduction is available at the rate of 30%. Therefore, out of 1,20,000, 70% taxable value is only 70%. 70% is nothing but 84,000. 84,000 is only taxable. Taxable in both cases because the property was located in India. place of accrual located in India. Place of accrual if located in India, then don't consider the place of receipt. So even if place of receipt located outside India, it will be taxable in all cases irrespective of the residential status. Therefore taxable in both the cases. 84,000. 84,000. Because place of accrual located in India. Act says that either place of accrual or place of receipt, if any one located in India, then it will be blindly taxable in all cases irrespective of the residential status of the assessee. Important point. Next, one more. Agricultural income from land in outside India. Nepal. So place of accrual located outside India. Receipt in Nepal. Receipt also located in outside India. Accrual outside India, receipt outside India. If both located outside India, then it will be taxable only in the hands of first category, that is resident and ordinary resident. So not taxable in the hands of non-resident. Taxable in only resident and ordinary resident. Point number 3, taxable only in the hands of resident and ordinary resident. Not taxable in the hands of non-resident, because the place of accrual and place of receipt both located outside India. Next, interest on savings bank deposit in UCO Bank, Delhi. So Delhi bank, the bank was located in India. Therefore, the income generated in India, that is place of accrual located in India. Therefore, it will be taxable in all 2 cases. Taxable in 2 cases. Point number 4, taxable in both the cases. 18,000. 18,000. Taxable in both the cases because place of accrual located in India. But one more important point, savings bank interest. Savings bank interest is eligible for chapter 6 year reduction. If he is a senior citizen, he is eligible for 80 TTB. If he is not a senior citizen, then 80 TT. And one more important, here the assessee is a senior citizen. Assessee is the senior, 65 years. But 80 TTB is available. But TTB is available only to resident assessee, resident and ordinary resident. So TTB is not available to non-residents. So please go and check section 80 TTB applicability. 80 TTB is available only to resident senior citizens, not applicable to non-residents. Whereas 80 TTA is applicable to not only residents but also non-residents. TTA, there is no restriction of residential status in TTA. While claiming TTA, the assessee may be either resident or non-resident. But while claiming the TTB, the assessee must be resident senior citizen. So here the resident and ordinary, the first category is entitled to claim 80 TTB, but second category is entitled to claim 80 TTA. So resident and ordinary resident is eligible to claim 80 TTB. ROR 80 TTB available, up to 50,000 is available 80 TTB. Therefore entire 18,000 will be allowed as deduction under section 80 TTB. But whereas non-resident is eligible only for 80 TTA, that too only 10,000. So we'll reduce these deductions from gross total income. Just wait. Next, point number 5. Income earned from business in London which is controlled from Delhi. Earnings located outside India. Earnings located outside India. Receipt 30%, 35,000 received in India. 35,000 received in India. Total amount 60,000. So this amount shall be classified into 2 types, 35,000 and 25,000. So 35,000 earnings located outside India, place of accrual located outside India, but place of receipt in India. Therefore, it will be taxable in all 2 cases. Taxable because receipt located in India. Act says that either earnings or receipt. If any one located in India, then it will be taxable blindly in all cases, irrespective of the residential status. Therefore, what is the treatment of 35,000? 35,000 will be taxable in 2 cases because the receipt located in India. So what about remaining 25,000? Remaining 25,000, earnings outside India, receipt also located outside India, the head of income is PGBP, and the business controlled from India. The business controlled from India. This will be taxable in only two cases, resident and ordinarily, resident but not ordinarily, non-resident not taxable, taxable not taxable. Taxable in only first case, this is resident and ordinarily resident, but not to non-resident. So go and verify the provision. So it's a special provision. So earnings located outside India, receipt located outside India, the head of income is PGBP and controlled from India. It will be taxable in only first case, and second case is also, second case is resident but not ordinarily. But here we are required to answer this question only in two cases. So the third case it will not be taxable. Third case is non-resident. Non-resident point of view, this amount will not be taxable. So taxable first 35,000 taxable in both the cases. So in first case entire 60,000 will be taxable. In second case only 35,000 will be taxable, 25,000 not taxable. Point number 5. ROR, taxable value 60,000. Non-resident, taxable value is only 35,000. Important combination point. Next, gift received from his daughter on his birthday. Gift received from his daughter, received from relative. Whenever the gifts were received from relative, then it will not be taxable, not taxable. Exempt from tax, because gifts received from relative. Not taxable in both the cases. Okay. Next, past foreign taxed income brought into India, not taxable in all cases. Past foreign income, because such income is not related to current year. Next, fee for technical services rendered. So this is residential status 2 related section 9 related point. So fee for technical services. Fee for technical services, first identify payer and recipient. Fee for technical services rendered to Shine Limited, a foreign company. Fee for technical services rendered to Shine Limited, a foreign company, for business outside India. And received also outside India. So here section 9 says that first case the recipient is resident and ordinarily. Case 1 recipient is resident and ordinarily resident. Second case recipient is non-resident. Case 1 payer is a foreign company. The services were provided to foreign company, therefore the fee paid by foreign company. So here transaction between payer is foreign company, recipient is resident and ordinarily resident. So fee paid by foreign company to resident and ordinarily resident, the transaction between two non-residents. Section 9 says that if payment made by one non-resident to another non-resident, it will be taxable in India. It will be always taxable in India. Only, payer is a resident, payer is a non-resident, is nothing but foreign company. Recipient is a resident. The transaction between non-resident and resident. In this case, it will be treated as deemed to accrue or arise in India, except the services utilized outside India. It will be treated as deemed to accrue or arise in India. Deemed to or arise in India, except services utilized outside India. Except services outside utilized outside India. So, but here is the services utilized for a business outside India. Therefore, it will not be treated as deemed to accrue or arise in India. Therefore, not taxable. Deemed to accrue or arise in India except services utilized outside India. If services utilized outside India, then it will not be treated as deemed to accrue or arise in India. Therefore, it will not be taxable. That is one of the important point. Okay, therefore not taxable. Next, second transaction is resident, second transaction recipient is non-resident. Payer is also non-resident. Payer is also non-resident, foreign company. Transaction between foreign company and non-resident. Section 9 says that fee deemed to accrue or arise in India only if services utilized in India. Deemed to accrue or arise in India. Only if services utilized in India. But here the services utilized outside India, therefore not treated as deemed to accrue or arise in India, hence not taxable. So that's the treatment. Have you understood? The last point is very important, which is related to section 9. Point number 1. So first point, not treated as deemed to accrue or arise in India. Even if assessee is not treated as deemed to accrue or arise in India, the first status will be taxable as it is. Sorry, first status it will be taxable, irrespective, taxable in all cases, even if taxable. But here is not taxable because in first case the assessee status is ROR. ROR says that ROR is liable to pay tax even if earnings and receipts both located outside India. Here the income not treated as deemed to accrue or arise in India. Even in such case, the first category of status will be taxable automatically in India. Taxable in first case, but not taxable in second case. Because in first case, the assessee status is ROR. ROR always be taxable in India, irrespective whether the place of accrual and place of receipt, even if both the transactions were located outside India. Don't consider the place of accrual, don't consider the place of receipt. Resident and ordinary resident will be taxable always in India, irrespective of the place of accrual, irrespective of the place of receipt. But second case, non-resident. Non-resident is taxable in India only where either place of accrual in India or place of receipt in India. Otherwise, no need to pay any tax to the government. But here is place of receipt outside India. The point contains the information also outside India, receipt outside India, and this amount deemed to accrue or arise outside India because the services not utilized in India. Therefore, this amount will not be taxable, not taxable in the hands of non-resident. Taxable in only first case, not taxable in second case. Seventh point, taxable 12,000, not taxable in second case. 1,50,000 taxable in two cases, 84,000 taxable in two cases, 55,000 taxable in only first case, 18,000 taxable in two cases, 60,000 taxable in first case, 35,000 in second case. Sixth point, not taxable in all cases. Seventh point, taxable in only first case. Section 9. Please go and verify the provision related to section 9. Deemed to accrue or arise in India. The heading of section 9 is deemed to accrue or arise India. If transaction between two non-residents, the income shall be treated as deemed to accrue or arise in India only where the services utilized in India. Otherwise, it will not be treated as deemed to accrue or arise in India. Even in such case, the ROR will be taxable. ROR always be taxable, even if place of accrual not located in India. But non-resident is taxable only either place of accrual in India or place of receipt in India, if anyone connected with India. Otherwise, no need to pay any tax to the government. Okay, so this is the question number 9. I think last point is important point, relates to section 9. Please go and verify once again the provision relating to section 9. So after that, added this amount, these amounts, and we'll get gross total income and deduct chapter 6 year deduction 80 TTA TTB. That's the answer. Next, question number 12. Question number 12 is relates to clubbing provision. Clubbing, total income with clubbing provision. Computation of total income with clubbing provisions. Computation of total income with clubbing provisions. Problem number 12. Samrat and his wife, Mrs. Komal, holds 12% voting power each in ABC Limited. Mr. Samrat and Mrs. Komal are working in ABC Limited. However, Mrs. Komal is not qualified for the job. Mrs. Komal is not qualified for the job. From the following information given in respect of financial year 21-22, you are required to compute the gross total income of Samrat and Komal. So in ABC Limited, wife and husband, ABC Limited, husband having 12% shareholding, husband having 12% voting rights, wife having 12% voting rights. So here section 64 subsection 1 clause 2 gets attracted, remuneration to spouse. So remuneration to spouse section says that in husband or wife, if anyone having substantial interest in any concern and the other person is receiving remuneration without any qualification, then such remuneration shall be eligible for clubbing in the hands of person having substantial interest. Here, while calculating the substantial interest more than or equal to 20% voting rights. While calculating the substantial interest includes relative interest also. Relative interest also. So include the relative interest also. Therefore, while calculating the husband substantial interest, wife interest also to be considered. Therefore, husband substantial interest is equal to 12% for him plus 12% of his wife, total 24%. So wife substantial interest also same, 12% for her interest and 12% her husband, total 24%. So therefore, both having substantial interest in A Limited. While calculating the substantial interest, please go and verify section 64(1)(2). There was a provision called, while calculating the substantial interest, relative interest also to be considered. So relative includes spouse, brothers and sisters, lineal ascendant, lineal descendant. Substantial interest of all these persons also to be considered. So here husband and wife both are having substantial interest and both are receiving remuneration. But here wife is receiving remuneration without any qualification. Therefore, here 64(1)(2) says that wife's remuneration shall be eligible for clubbing in the hands of husband. So second point, salary. Salary earned by husband 8,50,000 minus standard deduction 50,000. Wife 5,50,000 minus standard deduction 50,000. So but wife's remuneration shall be eligible for clubbing in the hands of husband. So husband, wife. So salary income of husband is equal to 8 lakhs minus 50,000. Standard deduction 8,50,000 minus 50,000, 8 lakhs. And plus wife remuneration 5 lakhs minus 50,000 is equal to 5 lakhs. Total 13 lakhs will be taxable in the hands of husband, not taxable in the hands of wife. Total salary, because wife is receiving remuneration without any qualification. Therefore, the wife's remuneration will be eligible for clubbing in the hands of husband having substantial interest as per section 64 subsection 1 clause 2. Please go and verify that section, very important in examination point of view. Next, point number 1, dividends received by husband. Dividends received by husband 22,500, wife 45,000. Husband 50% of dividend of husband transferred to Kajal, daughter of his deceased brother. So one of the important points, section 60 gets attracted, clubbing provision. Section 60. Section 60 says that if any amount, if any income transfer of only income without transfer of asset, then the income so transferred will be eligible for clubbing in the hands of transferor. So husband received only 50% of amount, but balance 50% transferred to Mr. Kajal. Therefore, whatever the amount transferred to Mr. Kajal will be eligible for clubbing in the hands of husband. Therefore, husband dividend is equal to 22,500 plus 22,500. Total amount of dividend to be received by husband 45,000. Wife also 45,000. Because out of husband's 45,000 amount, 50% of amount dividend transferred to Miss Kajal, daughter of his deceased brother. But the same amount will be eligible for clubbing in the hands of transferor. Here the transferor is husband. So the same 22,500 will be added back to husband. That is, husband's total dividend is 45,000. But wife dividend is 45,000. But this dividend received after deducting TDS amount. So now the TDS amount shall be added back, gross up and taken into account while computing the total income. Net dividend is 45,000. But what is the gross dividend? TDS on dividend. TDS under section 194 on dividend is equal to 10%. Therefore, the amount received is equivalent to 90% only. But how it will be gross up? Therefore, gross dividend is equal to 45,000 into 100 by 90 is equal to 50,000. The gross amount of dividend receivable by husband. So, husband dividend income 50,000 taxable in the hands of husband, 50,000 taxable in the hands of wife, because the dividends were received after deducting TDS under section 194 at the rate of 10%. If dividend amount exceed 5,000, then it must be TDS subject to TDS under section 194. Therefore, the amount deducted as TDS shall be added back to the amount. Important point. Next, business income earned by Mr. Samrat from his sole proprietary business is 15,60,000 PGBP of Samrat. 15,60,000. 15.6 lakhs. No income for wife in this point. Next, interest on fixed deposit received by Mrs. Komal. This is wife's income. Interest. No income for husband. Wife 9 lakhs. Next. So minor income. Minor income will be added to the either husband or wife whose total income. First added the total income of husband. Then ascertain whose total income is higher. Then the minor income will be added. Minor children income shall be added to either husband or wife whose total is greater. Here husband's total is greater. Therefore minor income added to husband, not to wife. This is the total income of husband and wife. So this is the computation of total income with clubbing provisions. Clubbing provision, point number 1, section 60 gets attracted. Point number 2, section 64 subsection 1 clause 2, remuneration to spouse. Point number, last point, income of minor children. Section 64 1A. Minor income shall be eligible for clubbing in the hands of either of the parents whose total income is greater. Here husband's income is greater when compared to wife. Therefore, the minor's income shall be added to husband income. Okay, but before adding the minor's income, reduce 1500 as deduction under section 1032. Therefore, amount to be clubbed in the hands of husband is 54,000 minus 1500. 52,500. This is the amount to be clubbed in the hands of husband. Ultimate amount. This is the calculation of question number 12. Please verify once answer related to question number 12. This is salary income, husband's salary, wife's salary. Both are taxable in the hands of Samrat, husband, as per section 64 subsection 1 clause 4. Next, PGBP income of husband, no PGBP for wife. And the dividend income 50,000, 50,000. Gross income, gross dividend. gross after add back the TDS amount. Next, interest on fixed deposit wife. Therefore, total income of husband 29 lakhs 10,000, 9 lakh 50,000. Husband income is greater when compared to wife. Therefore, the minor's income will be eligible for clubbing in the hands of husband. So, minor income 54,000 interest received. So, one more important point. Interest is also net interest. Here also the TDS has made under section 194A. Interest received interest after TDS sum. Therefore, gross interest is equal to 60,000. Gross is equal to 60,000 minus 1500. Therefore, amount to be clubbed is equal to 58,500. 54,000 TDS under section 194A at the rate of 10%. Therefore, gross interest is equal to 54,000 into gross interest is equal to 54,000 into 100 by 90 is equal to 60,000. TDS provision is applicable for interest under section 194A. So, whatever the amounts received is after deducting TDS. Dividends TDS rate at the rate of 10% under section 194A. Interest received by minor son is subject to TDS under section 194A at the rate of 10%. Therefore, gross interest is equal to 60,000. Out of 60,000, reduce 1500 as the exemption under section 1032 of minor children. The balance 58,500 to be clubbed in the hands of husband, because husband income is greater when compared to wife. So, amount to be clubbed, the gross amount is equal to 60,000, exemption of minor children 1500, amount to be clubbed in the hands of husband 58,000. Then calculate the total income. This is the calculation procedure. So, don't forget, don't skip the problems covered in RTP applicable to May 2022. So, I think most important problems are involved in this RTP. Must prepared by each and every student who want to write the examination in May 2022. Okay. Next one, 11th question. 11th question is exclusively capital gain related, section 50B, slum sale. The similar problem is there in our material, in Masterminds material. The similar problem is there, but subject to some changes. Okay. So, Mr. Aditya is a proprietor of Star stores having 2 units. Associate is having 2 units. So, on 1/4/2021, he has transferred, date of transfer 1/4/2021. He has transferred unit 2. Transferred unit 2 only. So, which he started in 2004-2005. The unit was started in 2004-5. But it was transferred in 2021. Therefore, it is a long-term capital asset, more than 36 months. Next, by way of slum sale for total consideration of 18 lakhs. Total actual consideration 18 lakhs. And one more important point, last point, fair market value of the unit 2 on the date of slum sale is 18 lakhs 10,000 FMV. This is an amendment in Finance Act 2021. In Finance Act 2021 says that, so in case of slum sale, consideration is equal to fair market value to be considered, not the actual consideration. So, therefore, ignore the actual consideration, fair market value to be considered as a consideration. Therefore, here the consideration is 18 lakhs 10,000. That's the amendment in Finance Act 2021. Earlier there is no in existence of this provision. Therefore, in earlier, up to the assessment year, up to Finance Act 2021, actual consideration itself to be considered as actual consideration. But from the assessment year 22-23, that is from now onwards, while calculating the capital gain on slum sale, fair market value to be considered as consideration instead of actual consideration. Don't take the actual consideration. That is the recent amendment in Finance Act 2021. That's why so it is better to prepare this problem. Next, so the assessee was transferred only unit 2 for 18 lakhs. The fair market value is 18 lakhs 10,000, and the unit was started in 2004-2005. Therefore, it is a long-term capital asset. So details of unit 1 and unit 2. The transfer of unit 2 only. Ignore the details of unit 1. Ignore it. So consider the details of unit 2 only. So but whereas liabilities provided combinedly for both unit 1 and unit 2, but it was apportioned between unit 1 and 2. Unit 1 and unit 2. So give you the revised balance sheet of unit 1. Balance sheet of unit 1. So land 7.5 lakhs, furniture 5 lakhs, debtors 3.5 lakhs, patents 7.2 lakhs, 25 lakhs. Next, own capital does not consider because slum sale, consider slum sale, cost of acquisition is equal to net worth. Net worth formula is equal to total value of total assets minus outside liabilities. So outside liabilities is only to be considered for calculating the capital gain on slum sale. Total value of total assets minus outside liabilities is the cost of net worth. Net worth is to be considered as cost of acquisition. While calculating the net worth, outside liabilities to be considered. So revaluation reserve also not to be considered. Here the outside liabilities is bank loan, trade creditors, unsecured loans. So bank loan for unit 2, unit 1 70%, unit 2 30%. Bank loan, unit 2 30%, unit 1 70%, 70% for unit 1, 30% for unit 2. So 30% unit 2, 8,50,000 into 30%. And the next, trade creditors 20% for unit 2, 20% only to be considered. 4,50,000 into 20% is nothing but 90,000. Next, unsecured loans 30% of unit 2. Unit 2 30% of 4 lakhs. Unsecured creditors 30% only to be considered. This is the balance sheet of unit 1. Now calculate the net worth. Net worth is to be considered as cost of acquisition. Consideration already decided 18 lakhs 10,000. If you calculate the net worth, then you can get the answer. Consideration 18 lakhs 10,000 minus cost of acquisition. The balance is the capital gain. So next, land of unit 1, land of unit 2 was purchased in 5 lakhs rupees in the year 2004 and revalued at 7,50,000 as on 31st March 2001. So land revaluation reserve, revaluation figures does not consider while calculating the slum sale net worth. While calculating the net worth, the revaluation reserves does not consider. The land original value is 5 lakhs, but revalued amount is 7,50,000. So don't consider the revaluation amount 7,50,000. It will be revised as 5 lakhs. Revaluation amount does not consider for calculating the net worth of the business. Okay. So revaluation reserves does not consider. The revaluation reserve was created by upwarding the value of land. Upwarding the value of land from 5 lakhs to 7,50,000. The increased value to be kept in revaluation reserve. Revaluation reserve cancel. Revaluation reserve does not consider. Therefore, the land value reduced to 5 lakhs. So that is one of the important adjustment, because while calculating the net worth in slum sale, revaluation figures does not consider. That is one of the important point. Next, no individual. Next, patents were acquired on 1/12/2019. This is 1920, on which no depreciation has claimed. So one of the important point. So section 50B, section 50B, slum sale. Slum sale. Consideration is equal to fair market value of such business to be considered. This is an amendment in Finance Act 2021. Okay. Next, cost of acquisition is equal to cost of acquisition and cost of improvement is equal to net worth of the business to be considered. Net worth of business. Net worth of the business to be considered as cost of acquisition. Okay, how to calculate the net worth? Total value of total assets minus outside liabilities. Total value of total assets. How to ascertain the total value of total assets? In case of depreciable assets, WDV to be considered. In case of non-depreciable asset, book value to be considered. In case of 35 AD assets, nil to be considered. So these are the main calculations while calculating the slump sale. So that is, and one more important point here. So here, please refer the problem. Unit 2 was transferred. Assets details related to unit 2 land 5 lakhs because revaluation figures does not consider. One more important point in 50B, revaluation figures. Does not consider. For calculating the net worth. That is one of the important note. Okay, next. So here the total value of total asset, land value 5 lakhs to be considered because revaluation amount excluded. Next, furniture value 5 lakhs. There was an adjustment for furniture, fourth adjustment. Furniture of unit 2 of 5 lakhs rupees was purchased on 1/12/2020 on which no depreciation has been provided. Therefore, amount given in balance sheet is not a WDV, not a written down because furniture is a depreciable asset. For depreciable asset, WDV to be considered, but the furniture was actually purchased 5 lakhs, actual value to be recorded in the balance sheet. But Act says that for depreciable assets, WDV to be considered, but 5 lakhs is not a WDV. So we should require to calculate the WDV of the furniture in working note. Furniture purchase date 1/12/2020. So I give you the details of WDV of the furniture. As on 1/4/2021, that is first date of the current previous year. Furniture purchase value is equal to 5 lakhs. It was purchased on 1/4/2020. So it was purchased on 1/12/2020, that is 2021. So first depreciate the depreciation relating to 2021 minus depreciation for 2021. So section 32 PGBP says that while claiming the depreciation for first year, first check whether it was put to use for less than 180 days or more than 180 days. So here the asset was purchased on in December month, therefore it is less than 180 days. Therefore half depreciation will be allowed as deduction. Depreciation rate for furniture is 10%. Depreciation rate for furniture is 10%. Now less than 180, therefore half depreciation will be allowed. 5 lakhs into 10% into 50%, half depreciation, 25,000. Therefore WDV of the furniture is equal to 4,75,000. So 2021 depreciation has deducted, therefore the balance will be treated as WDV as on 1/4/2021. So furniture value to be considered as 4,75,000. Next, one more working note is there. Patents were acquired, adjustment number 3. Patents were acquired on 1st December 2019 on which no depreciation has claimed. Patents also a depreciable asset. So now calculate the depreciation on patents, WDV. So amount recorded in balance sheet is the original cost, not the WDV, 3,50,000, on which we should require to reduce the depreciation at the rate of 25%. Okay. So WDV of the patents, second working note. WDV of patents as on 1/4/2021. Patents was acquired, purchase value is equal to 3,50,000. It was purchased in December month minus depreciation for 2020. Sorry, it was purchased in 2019 December. Patents were acquired in December 2019. That is 1920. First depreciation 1920. Depreciation for 1920 less than 180 days of depreciation. 3,50,000 into 25% into 1/2. That is 50% of depreciation. This is WDV of the patents as on 1/4/2000. Cost of acquisition of patents. Cost of acquisition of patents 7,25,000. Cost of acquisition of patents 7,25,000. Right? Is it 7,25,000? Yes. Cost of acquisition of patents 7,25,000. Sorry, I was taken as a wrong amount. Cost of acquisition of patents is 7,25,000. First year depreciation 1920 depreciation. It was purchased in December month. Therefore, half depreciation will be allowed. That is 25% into 50%. That is 12.5%. So 90,675 minus WDV as on 1/4/2020 less depreciation for financial year 2021 also. So here full rate. Less than 180 concept is applicable only for the first year, not to subsequent year. Therefore, second year claim full depreciation 1,58,500. Therefore, the WDV of the patents at present is 4,75,789. Next, WDV of the furniture, original cost 5 lakhs, the depreciation of percent, that is 10% into 50%, that is 5% for financial year 2021. So 25,000, 4,75,000 is the WDV of the furniture. Therefore, calculate the net worth, computation of net worth, total value of total assets minus outside liabilities, less outside liabilities. Total value of total assets, land, book value to be considered, revaluation reserve does not consider. Land revaluation figure 7,50,000, but book value is 5 lakhs, 5 lakhs to be considered. Debtors, non-depreciable asset, therefore book value to be considered. And depreciable assets, WDV of the depreciable assets to be considered. Furniture, depreciable assets 4,75,000. Patents 4,75,781. So aggregate value of total assets 18,781 minus outside liabilities. 3 outside liabilities are there. One is bank loan, trade creditors and unsecured loans. All 3 amounts shall be deducted. Then we'll get the net worth. Therefore, we'll compute the answer directly. Simple. Full value of consideration, fair market value to be considered. Actual consideration does not consider. This is an amendment in Finance Act 2021. Amendment. Okay. Please prepare this problem because it includes amendment, the recent amendment. Next, expenses on transfer. Expenses on transfer given in problem. Transfer expenses. Expenses on transfer will be deductible from consideration, that is 78,000. Net consideration is equal to 7,32,000 minus cost of acquisition and cost of improvement being the net worth. Net worth is to be considered as cost of acquisition, 13,35,780. Then long term capital gain is equal to 3,96,290. Remaining problem is same as it was existing in your material already. So one of the problems, similar problem is there in your material. So be prepared, but this problem involved an amendment area, that is consideration to be considered as fair market value of such undertaking as on the date of transfer. Okay. So these are the main fundamental points for while calculating the slum sale, capital gain on slum sale. Consideration, fair market value to be considered, cost of acquisition and cost of improvement to be considered, net worth to be considered as cost of acquisition and cost of improvement. How to calculate the net worth? Total value of total assets minus outside liabilities. So total value of total assets, in case of depreciable assets, WDV to be considered. If WDV has not given in problem, then it will be calculated in working note. Here the same working note was made in this problem for furniture and patents. For non-depreciable assets, book value to be considered. For 35 AD assets, nil. So revaluation figures does not consider. Indexation facility also not available. Indexation facility not available, even if asset is a long term. Indexation facility not available. This is problem number. Next. Problem number 13. Problem number 13 is related to set off and carry forward, total computation of total income with the provisions of set off and carry forward. Set off and carry forward provisions related. Also important model, total income with set off and carry forward provisions. Okay, next, here the details. Income from salary 3,40,000. Long term capital gain on sale of shares of Reliance Limited STT has been paid. Therefore, it is a 112A loss. Loss under section 112A. There is no difference between 112 and 112A. The treatment is same. Set off this amount against other long term capital gain. Next, loss from letting out of property in Delhi. Loss from let out of property in Delhi. So 75,000. Interest on self-occupied property in Mumbai. Interest on self-occupied property in Mumbai. Winning from lottery tickets. So winning, cost of acquisition of lottery tickets, ignore, not deductible. Ignore. Because winnings doesn't have any deduction. No deduction shall be allowed from winnings. Next, profits and gains from manufacturing business after deduction of normal depreciation 10,000 and additional depreciation 4,000 PGBP. Next, long term capital gain on sale of house. This is 112 capital gain. The long term capital loss under section 112A can be set off against long term capital gain. No objection. Next, one more important, brought forward losses are there. Brought forward business loss of manufacturing 35,000. Unabsorbed normal depreciation 10,000. Brought forward loss from activity of owning and maintaining race horses. Owning and maintaining race horses can be set off against the same activity, but in the above table the income from same activity is not available. Therefore, this loss can be carried forward to subsequent year. Carry forward. Because there is no income during the current previous year for set off of this loss. Because loss from owning and maintaining race horses can be set off against the income from same activity. If income from same activity is not available, then such loss can be carried forward to subsequent year. Okay. Next, compute the gross total income of Mr. Rajesh for the assessment year 22-23 and the amount of loss, if any, that can be carried forward if he wants to opt the provisions of. So important point entante, this problem will be solved based on optional scheme. The assessee wants to opt for the provisions of section 115 BAC for the first time. If assessee opted the provisions under section 115 BAC, then house property, income from house property, self-occupied property, interest deduction not available. Interest deduction is not available to self-occupied house property if assessee opted the provisions under section 115 BAC. Interest deduction is not available. The effect of this optional scheme is interest deduction is not available. In PGBP, additional depreciation is not available. Therefore, the revised PGBP is equal to 94,000 plus 4,000. Normal depreciation available, but additional not available, 1 lakh. Interest on self-occupied property is not deductible. Therefore, the question of loss from self-occupied property does not arise. Ignore it. No interest deduction is available to self-occupied property. Therefore, the self-occupied property resultant income will be taken as nil. The negative result does not acceptable if assessee opted the provisions under section 115 BSc. That's the changes, that's the effect of optional scheme. So that is one of the important point. Income from salary 3,40,000. Long-term capital loss under section 112A 1,15,000. Loss under the head loss from house property, let out property 75,000 acceptable. Interest on acquisition self-acquired property in Mumbai not acceptable because he has taken the option under section 115 BSc. Winning from lottery tickets, yes, other sources income, income from other sources. Cost of acquisition of lottery tickets not deductible because winnings doesn't have any benefits. Next, PGBP after claiming normal depreciation, additional depreciation, but additional depreciation is not available. Therefore, the additional depreciation add back to the profit. Therefore, the revised PGBP is 1 lakh and long-term capital gain under section 112 1,40,000. Except a two effect due to option, here the assessee is not entitled to claim interest for self-occupied property and additional depreciation, except that remaining acceptable. Brought forward business loss from manufacturing 35,000. It can be set off against current year business income. Unabsorbed losses, unabsorbed normal depreciation 10,000. It can be set off against first PGBP. If not, then it can be set off against other head of income except salary. Next, brought forward loss from activity of owning and maintaining race horses. It cannot be set off during the current previous year because such type of income is not available in current previous year. Therefore, such loss can be carried forward to subsequent year. This is the rules and regulations while solving this problem. So, please verify the printed solution. Salary income 3,40,000. Income from house property, self-occupied property, interest not deductible. Therefore, the resultant income is nil because the assessee has opted under section 115 BSc. Loss from let out property 75,000. Therefore, total loss in house property head is 75,000. It can be set off against other heads of income. Next, PGBP profit from manufacturing business 96,000. Add additional depreciation. Additional depreciation shall be add back because reason assessee opted the provision under section 115 BS. So, additional depreciation is not available to optional scheme. Therefore, add back to the profit. Therefore, the revised PGBP is 1 lakh. Minus brought forward manufacturing business loss 35,000. Unabsorbed depreciation 10,000. Therefore, the remaining taxable business income 55,000. Capital gain, long-term capital gain 1,40,000. Long-term capital gain under section 112A can be set off against other long-term capital gain. No objection. 1,50,000. Therefore, the remaining taxable capital gain 25,000. Winning from lottery other sources 40,000. Salary income 3,40,000. And one more important point is house property loss total 75,000. But this loss, interhead facility is available to house property loss. But whoever opted the provisions under section 115 BSc, the house property loss interhead facility not available. Interhead facility not available to house property loss. Interhead adjustment not available under section 115 BSc. If assessee opted the provisions under section 115 BSc, then self-occupied property interest deduction not available. Therefore, the resultant income from self-occupied property always be nil. Negative result does not accept. And one more point, let out, in case of loss in let out property, such loss cannot be set off against other heads of income. So, interhead facility is not available to house property loss. Therefore, it can be carried forward to subsequent year. If assessee has not opted the provisions under section 115 BSc, then the loss of house property worth 75,000 can be adjusted against other heads of income. Either it can be adjusted against salary income, or it can be adjusted against PGBP, or it can be adjusted against capital gain. So in these three areas, it can be adjusted in any areas whichever is beneficial to assessee if does not opted the provisions under section 115 BSc. But here assessee opted the provisions under section 115 BSc. Therefore, interhead facility of the house property loss does not arise. Therefore, interhead adjustment not available to house property loss. Therefore, the house property loss can be carried forward to subsequent year. That's the basic points to be followed in this problem. So anyway, this is also an important problem because this problem was answered based on optional scheme 115 BSc. Have you understood the point? So important, answer this question based on the optional scheme under section 115 BSc. So you should require to know what are the benefits lost by the assessee if assessee opted the provisions under section 115 BSc is the important. So I'll give you some information. House property head interest deduction is not available to self-occupied property. Therefore, the question of negative result does not arise to self-occupied property. But the resultant income in self-occupied property is always nil. And whereas in let-out property, there is no effect of optional scheme in let-out property. You can claim the interest in let-out property also, no objection. So, one of the important. And one more important, generally interhead adjustment is not available to house property loss. It can be adjusted against any head of income except winnings. But if assessee opted the provisions under section 115 BSc, then interhead facility is not available to house property head. So house property loss cannot be adjusted against other heads of income. Therefore, it can be carried forward to subsequent year. So here owning and maintaining race horses loss is not adjustable because they are not having similar type of income, same type of income not having by the assessee in this financial year. Therefore, such loss can be carried forward to subsequent year. So brought forward business loss, brought forward depreciation can be adjusted against PGBP income, no objection. Okay. Yeah. Problem number 14, PGBP. Problem number 14, PGBP. So Rishabh, a resident individual, age 52 years, is engaged in the business of manufacturing cloths. Therefore, he is eligible for additional depreciation. So he earned a profit of rupees 82,45,000. So net profit has given in the problem 82,45,000 as per the profit and loss account after debiting the certain items as follows. So what are the amounts debited in P&L account? Depreciation debited already 15,40,000. Next, short-term capital gain on transfer of listed shares in a company on which STT paid. This is 112A. 112A capital gain. 112A capital gain. Therefore, it will be taxable under the head capital gain. Therefore, it will not be recorded in the business books of accounts. But this amount was credited in P&L account. Therefore, this amount shall be disallowed. And transferred capital gain chapter. So this amount was disallowed from credit items and shifted to capital gain chapter. And depreciation, no doubt, is a business related expenditure. It's an allowable expenditure. Next, he received income tax refund. Income tax refund not taxable. One of the important, but interest on income tax refund taxable under the head income from other sources. But this amount was also credited in P&L account, business P&L account. Therefore, disallowed. These two items shall be disallowed from credit side because these two amounts was already credited in P&L account, not allowed as a business incomes. Point number 2, shifted to capital gain. Point number 3, income tax refund not taxable, but interest on income tax refund will be taxable under the head other sources. That's the treatment of point number 3. Next, dividends income, it will be taxable under the head other sources, but credited in business P&L account, therefore disallow. It will be taxable in other sources, but it was created in P&L account, therefore it shall be disallowed. Have you understood? Next, additional information. Mr. Rishabh installed a new plant and machinery for 65 lakhs. He was installed a new plant and machinery for 65 lakhs on 1/10/2021, which was put to use on 1st January 2021. Depreciation including additional depreciation on this amount of rupees 65 lakhs is included in the depreciation debited in P&L account. That is, it was included in the depreciation amount of 15 lakhs 40,000. Yes, the depreciation on this asset has already debited in P&L account. It was included in 15 lakhs 40,000. So included in depreciation debited in profit and loss account, which has been computed as per income tax rules. So no objection, it will be allowed as deduction. Assessee is entitled to claim additional depreciation also because he is a manufacturer. Okay, that is next. Rishabh took a loan. This is one of the important point. Rishabh took a loan from SBI of 50 lakhs on 15/9/2021. 15/9/2021, assessee has taken a loan at the rate of 10.5% per annum to purchase such plant and machinery. Such plant and machinery is nothing but the plant and machinery covered in point number 1, that is 65 lakhs worth plant and machinery. For the purchase of this plant and machinery, he was taken a loan of 50 lakhs on 15/9/2021 at the rate of 10 point. To purchase such plant and machinery, total interest up to 31st March 2022 has been paid on 31st March 2022 and the same has been debited in profit and loss account. Same has been debited in profit and loss account. This treatment is not correct. Because in depreciation section, one provision is there. If assessee has taken any loan for purchase of assets, then some portion of interest shall be capitalized. Capitalized is nothing but added to the asset value and claim depreciation. But here, what is the date of purchase? Capitalization of interest from the date of borrowing, up to the date of asset put to use. Up to the date of first put to use, the interest between these two dates shall be capitalized in the books of accounts. That is the correct answer. But the entire amount of interest is debited in P&L account. That's the not correct answer. Okay, but here date of borrowing is equal to 15/9/2021. Date of put to use is equal to point number 1, 1/1/2020. From 15/9/2021 to 1/1/2022 is nothing but 15/9/2021 to date of put to use 1/1/2022. So that is one of the important point. The interest between these two dates, shall be added to the asset value, capitalize. Here the interest is equal to period between these two dates are 3.5 months. Interest relating to 3.5 months. 50 lakhs loan into 10.5%. 10.5%. 10.5% into 3.5 divided by 3.5 divided by the loan was taken 15/9/2021. 6.5 is equal to 3037. So the interest between these two dates, the interest shall be capitalized. Interest shall be capitalized. That is the treatment. Capitalized is nothing but added to the asset value. Added to asset value. And claim depreciation. Both normal and as well as additional, because he is a manufacturer. Normal depreciation, additional depreciation. But actually, actual treatment was made by the assessee is entire amount of interest debited to P&L account. Now disallow such portion of interest related to 3.5 months and add back to the asset value, and the asset value will increase, and the increased value is eligible for depreciation for both normal and as well as additional depreciation. This is the treatment. I think in this problem this is the most important point. Please prepare well, very important. Please verify the answer. What is the treatment made by the assessee? I will give you the clue how to answer this point. So interest related from the date of borrowing to the date of asset first put to use. The interest between these two dates shall be capitalized. Capitalized is nothing but added to the asset value. So added to 65 lakhs. and the increased asset value will be eligible for depreciation, normal plus additional depreciation. That's it. Next, advance tax paid during the year. Advance tax is deducted from tax liability. Deducted from tax liability. Deducted from tax liability. This is the treatment of advance tax. Okay. Next, Rishabh purchased goods 40 lakhs from Mr. R. So his brother, goods was purchased from his brother. The market rate is 35 lakhs. Market rate 35 lakhs. 40A subsection 2. 40A subsection 2 says that unreasonable payments made to relatives or close associates shall be disallowed. Therefore, out of 40 lakhs, 5 lakhs will be disallowed. 5 lakhs shall be disallowed. Advance tax also disallowed. Not at all eligible as business expenditure. It will be deducted from tax liability. Next, he paid 40,000 as life insurance premium taken on the life of his married. Chapter 6 year deduction. Life insurance premium policy was taken on 1/4/2016. The policy value is 5 lakhs. Therefore, 10% is allowed as deduction. Up to 10% allowed. 5 lakhs into 10%, 50,000. But actual premium paid is equal to 40,000. Therefore, the amount paid is below the limit. Therefore, entire amount paid will be allowed as deduction. Therefore, 80C is equal to 40,000 will be allowed as it is, because it was within the limits. Maximum limit for claiming deduction is 10%. That is 50,000. If payment exceeds 50,000, then restricted to 50,000. But here the payment is less than 50,000. Then whatever the payment made by the associate shall be allowed as deduction as it is. So next, on 1/7/2021, Rishabh withdraw 1.5 crores. So fourth one, he paid 45,000 by check towards health insurance premium 80D. 80D allowed only 25,000 only. If associate is a senior citizen, then we allowed up to 50,000. But here associate is not a senior citizen. Therefore, restricted to 25,000. 80D. Next, last one, he withdraw an amount of 1.5 crores in cash. 1.5 crores in cash, sir. Three current accounts, from 3 current accounts, he withdraw 1.5 crores. Therefore, here the associate shall made a TDS. TDS shall be made on withdrawal of cash in excess of 1 crore. In excess, here in excess of 1 crore is equal to 50 lakhs. 50 lakhs into TDS rate 2%. 1 lakh. 1 lakh shall be made as TDS. So 194N. So TDS as per section 194N at the rate of 2% of on cash withdrawal exceeds 1 crore. So aggregate amount of withdrawal. He aggregate amount withdrawal from 3 current accounts 1.5 crores. Excess amount shall be subject to TDS. Next, these are the provisions relating to this point. All the points are very easy except one point. Interest point is very important and TDS point is also very important. Okay, but you are required to compute the total income of Rishabh for the assessment in manner so that can maximum tax savings. Answer this question in a manner so that he can make maximum tax savings. That is, it is better answer this question in 2 ways: normal tax rates, optional tax rates. Normal, optional. Under section 115 BAC. So select most beneficial option to minimize the tax liability. That's the question. Compute the PGBP income. So we are discussing all the provisions based on the normal calculation sum. But if he opted the optional provisions under section 115 BAC, then additional depreciation not available. Cancel the additional depreciation and add back to the net profit. Then the revised profit is equal to profit as per optional scheme. And the chapter 6 year deductions not available in optional scheme. Chapter 6 year deduction 80C, 80D, these are the deductions not available in optional scheme, except 2 adjustments. Remaining all are same in both normal and optional. You can change those options. So in normal scheme, you can claim additional depreciation and chapter 6 year deduction. In optional scheme, we cannot claim additional depreciation and chapter 6 year deductions. That's only the difference between normal and optional. So now you can verify the answer based on the explanation given. Have you understood the provisions? So I think point number 2 is very important. Next, question number 15. Question number 15 is Mr. Shivam is a US citizen. US citizen. She got married. Mr. Sriram, an Indian citizen. Shivani, Mrs. Shivani, is a US citizen. She got married to Mr. Sriram, an Indian citizen and resident of India in the year 2015. Resident of India in the year 2015. Since then, she has been staying in India. Since then, she has been staying in India is nothing but therefore, since she has been staying in India since 2015. Therefore, the residential status is equal to resident and ordinarily resident. That's confirmed because she stayed in India since 2015. Therefore, he was satisfied almost all the conditions. Therefore, her status is resident and ordinarily resident. Okay. So next, she has a bank account in US. She sold a residential house in US and earned a long-term capital gain of 2 lakhs. It's this section. This problem is relating to 139(1), section 139(1) related case. Filing the return of income. Is she filed the return of income? The question is she required to file the return of income or not? Please explain. It's a theory question. Just you can verify 139(1). You can get the answer for this question. So the status of the assessee is resident and ordinarily resident, and she has a capital gain 2 lakhs and it was reinvested and claim exemption under section 54 EC. So individuals are required to file return of income only if their total income exceeds basic exemption limit before claiming chapter 6A and 54 series. So before claiming, here 54 EC has claimed by the assessee. So capital gain 2 lakhs, gross capital gain 2 lakhs. Entire 2 lakhs was claimed as exemption under section 54 EC. Under section 54 EC. Entire 2 lakhs. Therefore, net capital gain 0. So, is she required to file return of income? Act says that individuals are required to file return of income only if their total income exceeds basic exemption limit before claiming exemption under section 54. Therefore, please consider this amount. Before claiming exemption, her total income is 2 lakhs, not exceeding basic exemption limit, below the basic exemption limit. Basic exemption limit. Therefore, she is not required to file return of income actually. But in 139(1), one special case is there. One special case is there. That case says that resident and ordinarily resident, even if they are not required to file return of income in India due to not having any income, they are also required to file return of income if they are having any if they are a beneficial owner or beneficiary of an asset located outside India, or so signing authority of an account located outside India. Actually, she is not required to file return of income because her total income is below the basic exemption limit. Actually, not required to file return of income. But one of the important, she has a bank account in US. She maintains a bank account in US. For this purpose, she also required to file return of income mandatorily. Filing return of income mandatorily. This is the special case. Resident and ordinarily resident who are not having any income in India, actually they are not liable to file any return of income in India, but they are also required to file return of income in some exceptional cases. So what are the exceptional cases? One is, so if he is a beneficial owner or beneficiary of an asset located outside India, or if he is a signing authority of an account located outside India. Therefore, here assessee is a signing authority of bank account in US. For that purpose, he is required to file a return of income mandatorily, even if he is not having any income, even if his total income not exceeding basic exemption limit. That's a purely theory question. Go and verify section 139 subsection 1 special cases. Special cases, I think point number C, D. This concept was involved in point number C. Point number C, I think. Please go and verify clearly. In masterminds material. So in other material, it may be covered in any point. Have you understood? It's a 139(1) related. Yes, here assessee is required to file return of income mandatorily because maintaining a bank account in US. Close. Point number 8. This is one of the important because latest amendment related problem. Finance Act 2021. ULIP. maturity amount of ULIP. Act amendment says that amendment recently made an amendment by the central government in Finance Act 2021. The amendment is, if ULIP has taken on or after 1st February 2021, then the contribution in any financial year during the life of such policy exceeds 2,50,000, then the maturity amount is not eligible for exemption. That's the provision. If assessee has taken more than one ULIP, then aggregate amount to be considered instead of single contribution. Aggregate amount of contribution, so for all such ULIP policies cannot exceed 2.5 lakhs. If it exceeds 2.5 lakhs, then the maturity amount and the amount received at the time of maturity of those policies shall not be eligible for exemption under section 1010D. 1010D exemption not available. Okay, so here please analyze the question. Mr. A has taken two ULIPs. One was 1/1/2021 before amendment. Before, if policy was taken before the date of 1st February 2021, then you can follow the old provision. Old provision says that always eligible for exemption. So the second ULIP was taken 1/5/2021. This was the amendment related part. Next, the sum issued a ULIP X. ULIP X is nothing but first one. Sum issued 30 lakhs and 40 lakhs ULIP Y respectively. The annual premium paid by Mr. A and during the previous year 21-22 is 3 lakhs for ULIP X, 4 lakhs for ULIP Y. Okay. So actually in both the ULIP policies, the premium exceeds 2.5 lakhs. Even in such case, ULIP X is still eligible for exemption because amendment is not applicable to policies taken before 1st February 2021. So the amendment effective date 1st February 2021 on or after. If date of policy before 1st February 2021, then exemption is available under section 1010D. Even if policy premium exceeds 2.5 lakhs, no objection. But the second policy was taken on 1/5/2020. It was taken after 1/2/2021 and the premium paid is 4 lakhs. Therefore, the maturity amount of second policy will be taxable. Maturity amount will be taxable. Exemption not available. 1010D exemption not available. That's the answer. So correct answer is A. Consideration received on the maturity of ULIP X would be exempt under section 1010D. Exemption is available to ULIP X, while the profit and gains from receipt of consideration on the maturity of ULIP Y would be taxable. That is exemption not available. So answer is A. Amendment related MCQ, I think important amendment in the upcoming examination. Next, Rajesh 53 years and his wife Mrs. Soumya age 50 years are citizens of country X, foreign citizens. They are living in country X. They are living in outside India at present. They are not liable to tax in country X. They are not liable to tax in country X. Country X is nothing but outside India. So both of them have keen interest in Indian culture. Mr. Rajesh parents and grandparents were born in country X. Mrs. Soumya visit India along with her Rajesh for 4 months every year to be with her parents. 4 months every year to be with her parents is nothing but 120 days in each year. So next, Rajesh for the 4 months every year who are born in Delhi. So Rajesh parents, Mr. Rajesh lived in Delhi. So one of the important part, Rajesh parents and grandparents were born in country. Mrs. Soumya visits India along with Mr. Rajesh for 4 months every year to be with her parents who were born in Delhi. Yes, Soumya's parents born in Delhi, Rajesh parents born in country X. So therefore, Rajesh nowhere connected with India. So both are foreign citizens and Rajesh parents also born outside India. But here one of the important, Soumya's parents were born in India. Therefore here the Soumya will be treated as person of an Indian origin, because their parents stay in India, born in India, who were born in Delhi and have always lived in India. During their stay in India, they organize a cultural program in Delhi NCR. Income of Rajesh and Mr. Soumya from the Indian source for the previous year 21-22 is 18 lakhs and 16 lakhs. Rajesh nowhere connected with India, but so Rajesh is a foreign citizen. Rajesh is a foreign citizen. Rajesh is a foreign citizen. The ultimate conclusion is Rajesh is a foreign citizen. But Soumya is a person of an Indian origin. Soumya is a person of an Indian origin. Person of an Indian origin. Both the persons visit India and stay in India each year 120 days. Visit India. Visit India. Visit India and stay 120 days in each financial year. So visit India and stay 120 days in each year. This is the conclusion in this question. But how to solve this question? What is the residential status of Rajesh and Soumya? Rajesh is a foreign citizen. Need to calculate B1 or B2. Need to check general rule B1 or B2. So general rule B1 or B2. B1 says that stay in India for at least 182 days during the previous year. It was not satisfied, but B2 was satisfied. Therefore he will be treated as, and A1 also satisfied, A2 also satisfied. Please check the conditions. Therefore the Rajesh status is resident and ordinarily resident, because every year he visit India and stay in India 120 days in each financial year. So, but what about Soumya? Indian person of an Indian origin visit India. Person of an Indian origin or Indian citizen visit India will be treated as an exception. Exception 2. Exception 2. Soumya covered in exceptional 2. Exception 2 is having two parts. Part 1, Part A, total income Indian sources does not exceed. Total income from Indian sources less than or equal to 15 lakhs. Then need to check only B1, that is 182 days. Part B, in exception 2, total income from Indian sources exceeds 15 lakhs. Then need to check B1 or modified B2. B1 or modified B2. B1 or modified B2. So here Soumya's total income is 16 lakhs. If it exceeds 15 lakhs exceeding 15 lakhs, therefore she was covered in part B. She was covered in part B in exception 2. Therefore need to check B1 or modified B2. B1 not satisfied. B1 182 days. B2 modified B2 says that during the current previous year 120, preceding 4 years 365. Modified B2 is equal to during the current previous year at least stay in India 120, preceding 4 years 365. Here Soumya was satisfied this condition. Current previous year 120 days stay in India, preceding 4 years 4 into 120 480 days, because both the persons are visit India each and every year and stay at least 120 days in each financial year. So therefore the modified B2 was satisfied. Therefore Soumya will be treated as resident but not ordinarily resident. So here one of the important point is, whenever the modified B2 was satisfied by the assessee, then need not check additional conditions. Additional conditions are not applicable to those assessees whoever satisfy the modified basic condition 2. Therefore he will be treated as always resident but not ordinarily resident. That's the answer. So Rajesh status is resident and ordinarily resident. Soumya's status is resident but not ordinarily resident. Rajesh is a foreign citizen. Soumya is a person of an Indian origin. For Rajesh, need to check B1 or B2, general rule. But Soumya was covered in exceptional cases. Exception to part 2. Okay. So what is the correct answer? Both are resident and are correct. Both are non-resident. Soumya is resident but not ordinarily resident in India. Rajesh is resident and so D is correct answer. Option D is correct. Go and verify the residential status of individual and exceptional cases also. If an Indian citizen or person of an Indian origin visit India during the current previous year, so please check whether his total income from Indian sources does not exceed 15 lakhs or exceed 15 lakhs. If it does not exceed 15 lakhs, then need to check B1 only. If it exceeds 15 lakhs, then need to check B1 or modified B2. B1 says that stay in India for at least 182 days. Modified B2 says that so stay in India during the current previous year at least 120, in preceding 4 years for 365 days. Here Soumya was satisfied, modified B2. Therefore, she will be treated as resident but not ordinarily resident. How to decide as not ordinarily resident? If modified B2 was satisfied, then additional conditions need not check. Then automatically the assessee shall be treated as not ordinarily resident. That's it. Have you understood? So my suggestion is, so don't forget, compulsory you must prepare each and every question involved in RTP applicable to May 2022 exams. I think as my opinion, some important, most important questions are there. So question number 10 is exclusively for salaries related question, in which two sections are there: 17 subsection 2 class 7, 17 subsection 2 class 7A. It's a perquisite related sections. So these are two new perquisites introduced in Finance Act 2020, but I think very difficult problem. So I give you the clear explanation how to solve this question. So actually this type of question also in your ICAI material, item question number 10. So please prepare this question mandatorily. I expect this question in next examination. Okay. So Mr. Sunil is CEO of Sheetal Textiles Limited. His basic salary 6 lakhs per month. He is paid 8% DA. He contributes 10% of his pay and DA towards his recognized provident fund, and the company also contributes the same amount. So here employee contributes the same amount, that is 10% of salary plus DA, basic plus DA, towards his recognized provident fund. The accumulated balance in recognized provident fund is 1/4/2020, 31st March 2021, 31st March 2022. That is opening closing balances in such fund in two different financial years: 50 lakhs 35,000, 71 lakhs 46,000, 94 lakh 57,700. So now calculate the taxable value of the perquisite under section 17 subsection 2 class 7, 17 subsection 2 class 7A for two different financial years, for assessment year 21-22, assessment year 22-23. is nothing but previous year 2021, previous year 21-23, 21-22. So calculate the taxable value of perquisite under section 17 subsection 2 class 7, 17 subsection 2 class 7A. This is the question. So I give you the answer how to calculate these perquisites. Perquisite 1, 17 subsection 7 is very easy. But second perquisite is most complicated perquisite. So we shall use a formula while solving that perquisite. Okay. So I give you the complete details about the answer. Here the basic salary of assessee is equal to 6 lakhs per month, and DA is equal to 8% of basic salary. So next, contribution made by the employer, contribution made by the employee, both the persons are contributed 10% of basic plus DA towards recognized provident fund. So first I will write the details. So basic salary is equal to 6 lakhs per month into 12, 72 lakhs. Dearness allowance 8% of basic salary, 72 lakhs into 8%. is equal to 5,76,000. Total basic plus DA is equal to 7,77,000, 77,76,000. Okay, so here further information is given is employer contribution, employee contribution, 2 years. So we should require to solve this question for 2 financial years, that is previous year 2021, assessment year 21-22. Employer contribution, 10% of basic plus DA, 10% of 77,76,000, that is 7,77,600. So in same financial, in next financial year also the contribution is same, 7,77,600. Employee also contribute the same amount, employee contribution 10%, 7,77,600, 7,77,600. Okay, so one of the important point, these are the contributions made by the employer and employee. We should require to calculate the taxable value of the perquisite in 2 different financial years, previous year 2021, previous year 21-22. Okay, so fund balances are there. Opening balance in such a recognized provident fund, opening balance for 2021 is equal to 1/4/2020, 50,35,000, 50,35,000. So closing balance is equal to 71,46,700. The 1 year closing balance shall be taken as opening balance for next year, that is 71,46,700. So next year closing balance is 94,57,700. So these are the balances in recognized provident fund, opening and closing balances. So now calculate the taxable value for the previous year 2021. Previous year 2021, 2 perquisites. Perquisite number 1, taxable value of perquisite under section 17 subsection 2 class 7. So 17 subsection 2 class 7 says that the contribution made by the employer, in excess of 7,50,000 will be taxable as it is under this section. Therefore, the first section calculation is very important. Taxable value is equal to 7 lakh, actual contribution made by the employer, contribution in excess of employer's contribution, in excess of 7.5 lakhs will be taxable under section 17 subsection 2 class 7. Here the actual contribution made by the employer 7,77,600, that is 7,77,600 minus 7,50,000, that equal to 27,600. That's the answer for taxable value under section 17 subsection 2 class 7. Next, another perquisite, one more important perquisite. The second perquisite is taxable value under section 17 subsection 2 class 7A. So this is most complicated. Annual assertion on the amount taxable under section 17 subsection 2 class 7. That is, whatever the amount taxable in 17 subsection 2 class 7, the annual assertion on such amount will be taxable under section 17 subsection 2 class 7A. That is, assertion is nothing but interest bonus, whatever it may be. Added additional amount, whatever the additional amount added on such contribution shall be taxable under 17 subsection 2 class 7. But this will be calculated based on the formula. The formula for calculating this amount is equal to formula for calculating this amount is equal to. So you can use the formula blindly. So don't go for practical analysis. It's a most confused formula. So you can use it as it is. That is PC2, taxable value under this section, is equal to PC divided by 2 into interest rate plus PC1 plus TP1 into interest rate. So this is the formula you can use while solving the taxable value under section 17 subsection 2 class 7A. But here is one of the, what is the meaning of PC, PC1, TP1, etc. Okay, I give you the details. First, PC is equal to, PC is nothing but contribution made during the previous year in excess of 7,50,000. PC is equal to employer's contribution in excess of 7.5 lakhs in current previous year, that is 2021. So whatever the amount made during the current, here the amount is 27,60,000. This is the answer for PC, 27,600. Amount contributed during the current previous year 2021 in excess of 7.5 lakhs is equal to 27,600. Okay, so one of the important. So one more, PC1, TP1. PC1 is equal to same employer contribution in excess of 7.5 lakhs in preceding previous year, that is 1920. So in 1920 this provision was not in existence, therefore nil, because these sections was introduced in Finance Act 2020 itself. Therefore it will be applicable only from the previous year 2021 onwards. So these sections were not in existence in preceding 2021. Therefore the concept of excess contribution in excess of 7.5 lakhs is not applicable in preceding previous years. Therefore in 1920 this concept was not in existence. Therefore this value shall be taken as nil. And the TP1 is nothing but taxable value. Taxable value under section 17 subsection 2 clause 7A in preceding previous year. So that is 1920. Here also nil, because this provision was not in existence in preceding previous year. Therefore it will be taken as nil. And rate, interest rate, R is equal to, interest rate is equal to, so most complicated calculation, interest rate is equal to interest credited in provident fund account during the current previous year, in current previous year, that is 2021, divided by average of the balances of opening closing balances and closing balances. So that is very important calculation, average of the opening balances and closing balances. So how to calculate this amount? Interest credited in fund account in current previous year 2021 is equal to, how to calculate this amount? So here, based on the information, what is the closing balance? 71,46,700. So how to calculate this amount? Very important. Closing balance is equal to 76,48,000, 71,46,700. 71,46,700 minus opening balance is equal to, opening balance in current previous year 2021 is equal to 50,35,000. 50,35,000. So opening balance 50,35,000, closing balance 71,46,000. Amount added during the current previous year is equal to 71,46,000. minus 50 lakhs 35,000 is equal to 21 lakhs 11,000. Amount added during the current previous year. Added during the current previous year. So amount added in such fund during the current previous year. This added amount involves three amounts, that is employer contribution, employee contribution. The balance will be treated as interest. That is, what is the employer contribution? 7,77,600. Employer contribution 7,77,600. 7,77,600. Employee contribution 7,77,600. Balance will be treated as interest. That is, how much interest involved in such amount? 7,77,600. 21,11,000. 21,11,000 minus 7,77,600 minus 7,77,600 is equal to 5,55,800. This is the interest credited in such account during the current previous year. And the next one, average of the opening closing balances. Opening balance is equal to 50 lakhs 35,000 plus closing balance is equal to 71 lakh 46,700 divided by 2 is equal to 50 lakhs 35,000 plus 71 lakh 46,700 divided by 2, 60 lakhs 90,850. So now fill the format for calculating the taxable value under section 17 to class 7A. So PC divided by 2, PC is equal to 27,600 divided by 2 into interest rate. So here the interest rate is equal to 5,55,800 divided by 60,90,850 is equal to 5,55,800 divided by 60,90,850. 60,90,850. So 0.091 914. 60,90,850. 5,56,500. 56,000 number, sorry, 56,500. Okay. Next, 0.091. 0.091. So 0.091. 14. 0.0914. So plus PC1 0 plus TP1 0 into 0.0914. So is equal to, the ultimate answer is equal to 1,261. This is the answer for taxable value under section 17 to class 7A. So got it? How to calculate the taxable value under this section? So this is most complicated and most valuable calculation. I expect this question in upcoming examination. Please prepare mandatorily. So these are the points are very important. How to analyze the formula. Next, we'll go to the next year. 21-22. 21-22. Taxable value under section 17 subsection 2 class 7. So here is same, taxable value is equal to employer contribution in excess of 7.5 lakhs. That is same amount is taxable here also. That is taxable value is equal to 27,600. So but here taxable value, another section, under section 17 subsection 2 class 7A. So here you can use the formula same. Taxable value is equal to PC divided by 2 into rate plus PC1 plus TP1 into rate. So here the PC is equal to same amount, excess contribution over 7.5 lakhs, employer contribution in excess of 7.5 lakhs. In current previous year, here the current previous year is 21-22, that is 27,600. Next PC1 is nothing but preceding year excess contribution in preceding previous year. Here the preceding excess contribution is available. Employer's contribution in excess of 7.5 lakhs in preceding year, that is 2021, that is also available, 27,600. Preceding year data is also available. Next, TP1 is equal to taxable value under section 17 subsection 2 class 7A in preceding year in 2021. It's also available, that is 1,261. 1,261. So, but here is rate is important. Rate, how to calculate the rate? So, rate is nothing but interest credited during the previous year, credited in 2021 divided by average of opening balance and closing balance. Opening and closing balance. So, interest credited in this account during the current previous year is equal to, so opening closing funds, here the closing balance in such year 94,57,700. 94,57,000. Closing balance 94,57,700. 94,57,700 and 71,46,700. Opening balance 71,46,700. 71,46,700. Then the difference between opening and closing balance. Difference between opening and closing balance is equal to 94,57,000. 23,11,000. So it includes the three amounts. One is employer contribution, employee contribution, interest. Employer contribution 7,77,600. Employee contribution 7,77,600. Balance interest, that is minus 7,77,600 minus 7,77,600 is equal to 7,55,800. This is the interest. Next, average of the opening closing balances. So opening 71,46,700 plus closing 94,57,700 divided by 2. So average of the opening closing balances 83,02,000. 83,200. So now the interest rate is equal to rate is equal to 7,55,800 divided by 83,02,200. That equal to, so rate is equal to 0.0910. 0.0910. That's it. You can fill up the formula and you can get the answer. So PC is equal to 27,600 divided by 2 into 0.0910 plus PC1 27,600 plus TP1 1,261 into 0.0910. So that's the formula. then you can get the answer of 3883. So this is the formula for calculating the taxable value of perquisites 1727, 1727A. 7 is very important, very easy to calculate, but 7A is most complicated. So it is better to mug up the formula as it is. Okay, important point. So then go to the next. Question number 1. It's a TDS provisions. TDS provision. So Subhash is a retailer, TDS related case scenario. TDS. So Subhash is a retailer of a car spare parts. He started his business in May 2020. His turnover for the previous year 2021 10.5 crores. So they generally purchased goods from car accessories company only. So only the car accessories company manufactures and sells spare parts directly to the customers as well as through e-commerce operators. Directly to the customer as well as through e-commerce operators. So two types of sales made by the manufacturer, that is directly sold to the customers and through e-commerce operators also, through Amazon, Flipkart, etc. So on the carparts.com, this is the portal mediator to sold the property through e-commerce platform, carparts.com. So car accessories and co. Turnover for the business for the previous year 2021 is equal to 115 crores. Okay. So here one of the important analysis is equal to, here the seller is car accessories and co. Seller is car accessories and co. Buyer is Mr. Subhash. So seller car accessories and co. Seller car accessories and co. Buyer is Subhash. So next, the seller's turnover in preceding previous year is equal to 10.5 crores. Preceding year turnover of the seller is equal to 10.5 crores, exceeds 10 crores. The buyer's turnover, buyer's turnover is equal to 10.5 crores. Subhash turnover 10.5 crores. Car accessories turnover is 15 crores. Next, the details given below. Date of credit to the account of the car accessories and co. Date of payment of car to car accessories and co. Value of spare parts, GST 18%, total value charged in the invoice. So here the GST, last paragraph, last but one line, the GST portion is indicated separately in the invoice of the car accessories and co. So if GST indicated separately in the invoice, here one of the important point, seller point of view, section 194 section 194Q gets attracted. Sale of goods if it exceeds 50 lakhs, then subject to TDS in excess of 50 lakhs. So here seller point of view, which section gets attracted? Here the seller is Subhash, car accessories and co. Here the buyer is Subhash. So buyer point of view, TDS gets attracted. TDS under section 194Q. Seller point of view, TCS gets attracted under section 206C 1H. So this is the main important analysis in this problem. So but both TDS and TCS gets attracted only if those turnover during the preceding previous year exceeds 10 crores. Yes, here Subhash turnover in preceding year, turnover in preceding previous year is 10.5 crores. So therefore TDS under section 194Q gets attracted. So here seller's turnover in preceding previous year is 15 crores. Therefore here TCS provisions gets attracted. So here Subhash is required to make TDS under section 194Q. So seller car accessories and co is required to collect TCS under section 206C 1H. But here is one of the important, for same transaction if TDS and TCS provisions are applicable, then TDS shall be made, ignore the TCS provision. If the same transaction, one of the important point, TDS under section 194Q and TCS under section 206C 1H are applicable. Then apply TDS provision only. And one more important point, TDS, TCS in these two sections gets attracted only if the turnover exceeds 50 lakhs during the current previous year. Sale value in excess of 50 lakhs, the excess amount is subject to TDS under section 194Q. The excess amount subject to collect TCS under section 206C 1H. Threshold limit here in both the sections. The threshold limit is 50 lakhs. Threshold limit is equal to 50 lakhs. And one more important, so TDS under section 194Q introduced recently, the effective date of TDS under section 194Q is equal to 1/7/2021. So from 1/7/2021 onwards, the turnover related after the period of 1/7/2021 is only subject to TDS under section 194Q. But TCS provision is applicable from the beginning. Okay, these are the main fundamental points related to 194Q and 206C 1H. Please go and verify those two sections clearly. Okay, so these are the turnover details during the current previous year. So, and one more important point, so threshold limit 50 lakhs, threshold limit 50 lakhs. So if both TDS and TCS gets attracted, then TDS provisions will apply as it is, ignore TCS provisions. Here, buyer's turnover, here buyer is Subhash. Subhash is required to make TDS under section 194Q. Seller is required to collect TCS under section 206C 1H. Okay, so buyer point of view, first apply TDS provision. So TDS provision says that the threshold limits exceed. For calculating the threshold limit shall be calculated from the beginning. But TDS shall be made only after the turnover related to the period after 1/7/2021. The first turnover was made before 1/7/2021. Therefore, TDS provision not applicable on this turnover. TDS not applicable on 40 lakhs because the turnover preceding the date of 1/7/2021, because the effective date of applicability of 194Q is equal to 1/7/2021. And the second also made in June, that is before 1/7/2021. So, but TDS provisions are applicable only to the remaining two turnovers. So, turnover 21 lakhs 50,000 and 10 lakhs 50,000. These two turnovers are only subject to TDS under section 194Q. So, because preceding turnovers relates to the period before 1/7/2021, the effective date of 194Q is from 1/7/2021. But while calculating the threshold limit of 50 lakhs, it can be calculated from the beginning. So, this 40 lakhs to be considered for threshold limit. 15 lakhs also to be considered for threshold limit. Yes, the threshold limit of 50 lakhs exceeds here. Therefore, the remaining turnover shall be subject to TDS under section 194Q. But one more important, TDS shall be made with GST or without GST. If GST specifically mentioned in the invoice, then TDS shall be made without GST. If GST not specifically mentioned in the invoice, then TDS shall be made including GST. But here the GST portion is indicated separately in the invoice. Therefore, so but one more important point, here the method of accounting when TDS, time of TDS under section 194 Q is equal to time of payment or entry in the books of accounts, whichever is earlier. Entry in the books of accounts or actual payment, whichever is earlier. So, for turnover 21 lakhs 50,000, so entry date 28 August 2021, payment date 17/8/2021. Therefore, whichever is earlier, 17/8/2021 is the time of deduction of TDS under section 194Q. But next last transaction 14 to 2022, 28 to 2022, this is the earlier date. So for making TDS for third installment, the time of TDS is 17/8/2021. For last installment 14 to 2021, because what is the time of TDS under section 194Q? At the time of payment or at the time of credit entry in the books of accounts, whichever is earlier. Okay, but one more important point, if TDS is required to made at the time of payment, then the TDS shall be made including GST. So that is one of the important point here. So for third installment TDS shall be made on 17/8/2021, that is time of payment. Therefore here the TDS shall be made the total amount including GST, that is 21,50,000. TDS shall be made on 21,50,000. So what about the last installment? Here the TDS shall be made at the time of credit entry in the books of accounts. So kabatti here the TDS shall be made excluding GST, that is it is sufficient to made, the third installment the TDS shall be made including GST, because the TDS was made in this case at the time of payment. So that is TDS shall be made on 25,37,000 TDS. But what about last installment? Here the TDS shall be made at the time of credit entry in the books of accounts. Whenever the TDS shall be made at the time of credit entry in the books of accounts, then the TDS shall be made excluding GST. That is, it is sufficient to make TDS on 10,50,000. These are the provisions relating to 194Q. 194Q TDS provisions are applicable only the turnover related to the period after 1/7/2021, that is before turnover is not eligible, but before turnover is also to be considered for calculating the threshold limit. While calculating the threshold limit, turnover from the beginning to be considered, but while making the TDS, turnover after the period of 1/7/2021 to be considered. So when TDS shall be made under section 194Q, the TDS shall be made when the actual payment or entry in the books of accounts, whichever is earlier. If you want to make the TDS at the time of payment, then the TDS shall be made including GST also. If you want to make the TDS at the time of credit entry in the books of accounts, then need to make TDS only excluding GST. So that is one of the important point. So for third installment, TDS shall be made on 25,37,000. For fourth installment, TDS shall be made on 10,50,000 at the rate of 0.1%. 0.1%, that is 2537 at the rate of 0.1%. At the rate of 0.1%. That is one of the important point. Here the question is Mr. Subhash is required to deduct tax at source in respect of the purchase transactions made directly with Car Accessories Limited? If yes, when and what is the amount of tax? Here the answer is B. Please verify the section of 194Q clearly. So many of provisions are there. When TDS shall be made, what is the threshold limit, on which turnover the TDS shall be made. These are the very important points. Next, is Car Accessories Company required to collect TCS? Is there any applicability of TCS under section 206C 1H? Yes, one of the important point. Here the TDS was made. Here the TDS was made on only third turnover and fourth turnover. First and second turnover, not applicability of TDS provisions under section 194Q, because the effective date of 194Q is 1/7/2021. Before that, there is no section of 194Q. So the turnover preceding the date of 1/7/2021 is subject to TCS because it was not covered in TDS provision. Therefore, this turnover, total turnover 47,20,000, 17,70,000 is total is equal to 47,20,000 plus 17,70,000, 64,90,000, 64,90,000 minus threshold limit in this section also same, threshold limit 50 lakhs. Therefore, balance is equal to 14,90,000. This amount is subject to TCS. Therefore, TCS shall be made on this amount at the rate of 0.1%. TCS is equal to under section 206C 1H is equal to at the rate of 0.1%, that equal to 1490. TCS is applicable only to first and second turnover because third, fourth turnover already subject to TDS. So that is second question answer C. Third question answer is assume that Mr. Subhash has started the retail business of car spare parts if business was started in May itself, then Subhash turnover commenced from May only. Then the Subhash turnover commenced because the business was commenced in May month. Therefore, the turnover is available only for third and fourth turnover. Third and fourth turnover aggregate does not exceed 50 lakhs. First two turnover not available because he started the business in May itself. Therefore, the available turnover is August related turnover and February related turnover. These two aggregate amount does not exceed less than 50 lakhs. Therefore, not exceeding threshold limit. Therefore, Subhash is not required to make any TDS on this amount because not exceeding the threshold limit. So that is one of the important part. But what about 206C1H? Here 206C1H gets attracted for all the payments. So for all three payments, the 206C gets attracted because TDS provisions not applicable. Whenever TDS provisions are not applicable, then TCS provisions are attracted as it is. So because 206C1H will be applicable from the beginning. So one of the important point. Here the answer is C. TDS provisions are not applicable here because the turnover does not exceed 50 lakhs. But TCS provisions are applicable. Okay. Next, the last one. So if the provisions of tax deducted collected at source attracted in these transactions with card parts, that online transactions also are subject to TCS under section 194O at the rate of 1%. That is the D. 194O, e-commerce operators. 194O says that if any commodities purchased through mediator, that is online transaction through Amazon or Flipkart, etc., whatever the online transaction, then whatever the amount paid through mediator is subject to TDS at the rate of 1%. So please go and verify the TDS sections 206C, 1H and 194Q. So then you get the answer. And the important case scenario, please verify it once. Okay, next. So question number 6. So ASEAN Developers has completed one of his housing project in Gurgaon in January 2020. So residential units. It has transferred 9 residential units in February and remaining 1 unit in May to Surat. ASEAN Developers transferred to Surat. So all units were transferred by way of first time allotment. The consideration received from Surat is equal to actual consideration 50 lakhs. Stamp duty value 57 lakhs. Okay, Surat. Subsequently, due to some emergency in family, Mr. Surat was in urgent need of funds and he sold such unit to Mr. Prakash. The Surat sold the same unit to Prakash for rupees 53 lakhs. Actual consideration 53 lakhs. Stamp duty value here is 61 lakhs. This is the information provided. What are the tax consequences in the hands of Surat? Tax consequences in the hands of Prakash. This is the question. So Surat's point of view, 2 heads gets attracted because he was purchased the asset worth stamp duty value 57 lakhs. So the same asset was transferred to Prakash. Same asset was transferred to Prakash. Therefore, when transfer of capital asset, need to calculate the capital gain. The Surat is required to calculate capital gain. Consideration is equal to 53 lakhs. While stamp duty value is equal to 61 lakhs. 50C says that actual consideration is less than stamp duty value, then stamp duty value to be considered as consideration. So Surat's point of view, capital gain is equal to consideration stamp duty value, that is 61 lakhs, minus cost of acquisition is equal to 50 lakhs, total 11 lakhs is the taxable capital gain, that is short term capital gain. So but what about Prakash point of view? The Prakash is sold such residential unit to Mr. Prakash in December 2021 for rupees 53 lakhs. Prakash point of view, the worth asset is stamp duty value of 61 lakhs. It was acquired by Prakash is only for 53 lakhs. So the benefit obtained by the buyer at the time of purchase of assets will be treated as gift. It will be taxable under the head other sources. Therefore, Prakash point of view, gift, taxable value of gift is equal to stamp duty value minus consideration is equal to 61 lakhs minus 53 lakhs, 8 lakhs. So taxable value in the hands of source. The question which answer is correct? Short term capital gain 11 lakhs, 8 lakhs is the gift, income from other sources. Point 1. If you answer this question in another way, the point B is also correct, but the ICAI recognized the answer of A. Therefore, it is better to answer as per the suggestion made by the ICAI. Okay, that's it. These are the problems involved in RTP 2022, May 2022. So please keep in mind, don't forget this RTP, compulsory prepare each and every question involved in this material. So some of the questions are very important and some of the questions relate to amendment. Okay. Thank you all of you.